We're talking all things to do with gold price action, or lack thereof, should I say, why gold has not been trailing upwards, but rather it's been consolidating downwards. Alain Corbani, portfolio manager of Finance SA, is back to discuss with us this very topic and why super cycles and commodity cycles are not necessarily the only answer. Alain, welcome back to the show.
Thank you very much, David. It's always a pleasure to have you with us and discussing all these very, very interesting events that are happening in our industry.
Very, very interesting indeed. And gold investors are frustrated that their investments are not doing well in the gold space. And so we're here to discuss why that is. So before we talk about your outlook for gold, let's revisit, we had you on the show 2 months ago, let's revisit the most important key drivers of the gold price.
So again, a quick reminder, when we talk about gold, whether you like it or not, keep in mind that it's a cyclical asset, and gold miners are cyclical by nature. So we started this bull gold cycle. The last one that started was 5 years ago at the end of 2015. And all the elements, fundamental elements, are still in place to see gold move higher. Now, your investors, your audience is a little bit impatient, and they are wrong to be impatient because it's never a straight line, never. And we always have hurdles to run up against, and this is exactly what has been happening since the month of August. We will talk about it, but since the month of August, nominal rates have readjusted. We talked about it last time we had you had me on your show, and we said that we needed to have some readjustments in those rates. So we talked about readjustments. If you recall, we didn't talk about normalization. These are two very, very different things.
Yes.
So when you come out of a recession, it's obvious that your rates represents, they recognize the weakness of the economy. So those rates were abnormally low, considering the fact that we were coming out of a recession. So we said, and we keep saying, that it was normal to have a readjustment. We also said that those rates, after being readjusted, will not go higher. Now, the key question, and we'll talk about it, the quick question is, what is the tipping point at which equity markets will refuse to pay more for rates which will be penalizing all sorts of assets, all kinds of assets. And we have reached this level. A lot of studies are showing that 134, 135, some are more aggressive, 140 for the 10-year yield would be the tipping point, at which, again, we will have a rebellion of all sorts of assets. And we have reached this level. If you look at the 10-year note, we are playing with the 135% levels. We hit 137, and the equity market between Friday, it's very fresh. So we have to be very, very careful in what we are saying, and we need to validate this point. But the fact is that equity markets don't seem to want to go higher because we have reached that level, that tipping point, where, again, higher rates will penalize equity markets.
Okay.
And if they penalize equity markets, obviously this is something that the central bank doesn't want to see. So most probably, if nominal rates, whether it's the 10, the 20, or 30-year rates go higher, are tempted to hit new levels, most probably we'll see the Fed intervene on those longer maturity bonds.
Alain, let's talk about the tipping point in just a bit. But I want to come back to normalization versus readjustment. This is the key here, because
Yes.
all summer last summer, we spoke in November, but all summer last summer, I was speaking to other economists, and everybody was saying, look, gold's fundamentals are still bullish. The Federal Reserve is unlikely going to raise rates for the foreseeable future for at least another 2 years. And they were right. The Federal Reserve did not. But nobody said that the bond market does not need the Federal Reserve to raise rates for the 10-year yield to rise. And that's exactly what happened. Explain this difference, please.
It's very simple. When you are the bond market is basically the ultimate referee, and the bond market naturally reacted to expectations of higher growth. We were initially talking about a growth rate for 2021 for the US economy around 5%. Then we moved to 6%. Then the most aggressive forecasts are now talking about growth rate for 2020 of the US economy around 7%. So if we do reach those 7%, assuming we reach those 7%, it's obviously more than natural and normal for the bond market to readjust.
I understand.
And to recognize the fact that with higher growth, you need higher rates.
Okay.
And this is exactly what happened. But the big difference between readjustment, which is exactly what we have seen over the last few months, and normalization is the language of the central bank. The central bank clearly has been saying over and over again that they were not going to increase the rates. And they also said that they are far from contemplating tapering. So before normalizing, you need to taper, and they are not tapering, and they are not going to normalize. So until probably 2023 or 2024, and they will only keep that in mind. That's very important, and they will only normalize if, and this is a big if, we have higher inflation and the forecasts for the growth rate are going to be validated.
Okay.
And keep in mind, and that's also a very important point, we're talking about a fantastic growth rate on the rebound of 5, 6, 7% for the US economy in 2021, but everybody agrees that it will be a one shot.
Right.
2022, 23, and forward will have much lower growth rate.
So while we're still talking about this, and I'll jump on to the other topics later, but while we're still talking about normalization, what will happen to gold if the Federal Reserve decides to normalize, decides to taper? We already saw what happens when the bond market decides to, price bonds down and raise yields. That is not good for gold. What will happen to the yellow metal once the Federal Reserve decides to raise interest rates?
This won't be good for the. This
okay.
will not be good. This will not be good. But again, this is not our scenario. The scenario is that with your massive stimulus, with whether it's fiscal, whether it's an aggressive monetary policy, we have those twin deficits which are hitting new records every month. So you cannot normalize unless you have inflation.
Right. Okay. Let's talk about
Keep
that. That's
in
the
mind.
key. So
there is no way we will normalize if the inflation forecasts and anticipations for higher prices don't go much higher. Today, we are at the 10-year inflation expectations are sitting around 2 to 12 to 15%, and they are coming. They have gone up dramatically. The same way they have gone up dramatically by almost 100 basis points, the same way those nominal rates have gone up by 100 basis points. So more or less, our real rates have stayed more or less stable.
Okay, so let's back up a bit. Let's explain to the audience the relationship between real interest rates and gold. There is an inverse relationship between gold and real interest rates, right? And so now we're going to break down the components. You were just talking about inflation. Before inflation, nominal yields, as you said, has gone up considerably since last we spoke. You had said this back in late November. You had said that you expect nominal rates to go up a little bit, and you were right. But it's gone up 50 basis points since the end of November to now. Is that in line with your expectations? Did it go up too much?
No. It's 135. Maybe we could have gone to, and we could go to 140, but we didn't think, and we still don't believe that those nominal rates can go higher. We do not. They will only go higher if inflation expectations are going higher. And we don't see that scenario playing out.
Okay. Now, so you're saying 135 right now, the level is the max right now, is the sort of the cap for now? Okay, yes. So why is the inflation expectation not trending higher, Alain? If the economy is improving, which according to the bond market it is, then why aren't we seeing inflation expectations?
Okay, this is a very good question, but keep in mind that we are only at 135 on the 10-year yield. Okay, 135 is still below the levels of the pre-pandemic. In 2019, we were around 170, 180 on the 10-year bond. So today we are only at 134, and we are only at 134 and not higher, just because the bond market is telling us we are not convinced that we're going to go much higher, because we are not convinced that we are facing a risk of hyperinflation, and we are not facing a risk of hyperinflation because we have major issues and deficits running. The twin deficits are again hitting new levels, new records, and this is a major problem for the economy to achieve a stable, long-term, higher growth than what we expect today.
Okay, so let's put these two pieces together now, your outlook for inflation and your outlook for nominal yields. Can the real yield now, Alain, go higher or lower from here?
Well, in our scenario, inflation expectations are going to remain at these levels.
Okay.
Assuming they remain at these levels as we forecast, nominal rates will not go higher. If nominal rates don't go higher and inflation expectations don't go higher, real rates will remain at these levels. We might even see one or two accidents along the road, and one of two accidents could see those nominal rates go lower, because right now everybody believes that we are heading towards new records for the equity markets. Everybody. The consensus is, and look at the levels of the S&P 500 or any other equity markets. Look at the emerging markets, how well they are performing. Look at the Nikkei in Japan getting back to all-time highs. We are all into this scenario according to which we are coming out of the recession with so much monetary policy, generous monetary policy, and so many aggressive fiscal policies. They will ultimately translate into much higher growth in 2021.
Right. It looks like the trajectory for both nominal rates and inflation is only up from here. If you look at the yield curve, for example, the 10-year minus the 2-year,
Yes.
that's steepening.
Yes.
So I'm wondering, Alain, which is likely to move up sooner, the nominal rate or inflation expectations?
Nominal rates, I repeat it, will not go higher.
Okay.
Because the central bank, the US central bank, the Fed, will make sure that they do not go higher. Because if they do go higher, and by higher, we're not talking about 10 basis points. If they go higher, if they decide, if the bond market
How can
decides
the central bank control the bond market's rates, Alain? I mean, the central bank has kept the Fed funds rate flat for the last year, and still the nominal rate has risen.
Because they haven't intervened on longer maturity bonds.
Okay.
And the next step, if those nominal rates are tempted to hit new higher levels, most probably you will see the Fed intervene on longer maturity bonds.
Okay, so that's the key. So the Fed is likely to intervene if rates move up even more. Okay, I understand that.
Absolutely.
Perfect. So then the key that we've narrowed down the key for gold, then the key rests on inflation, doesn't it? Because nominal rates will stay flat. The other component of real interest rate is inflation expectations. So what are the factors that you are looking out for in the economy before you decide, okay, inflation is going up now? Are you looking at the job market? Are you looking at consumer spending? What is an indicator for you, Alain?
We are definitely looking at the job market. We're looking also at what's going to happen to this bill in the $1.9 trillion proposal that is being discussed at the Congress, and it seems like this $15 per hour salary will not be part of the package. So as long as we have, in my opinion, as long as we have major imbalances, and we are here to have major imbalances for a very long time, we will not see inflation going much higher.
Okay.
And remember, if history tells you something, everything that all the central banks have been trying to do is trigger more inflation over the last decade. And they haven't been able to achieve it. Now, suddenly, some voices are saying that because the monetary and fiscal policies have never been so aggressive in the history, this will finally trigger a higher inflation. And we still believe that we have too many imbalances today to expect inflation to go much higher. And keep in mind, inflation is not coming from manufacturing. Yes, your PPI is going higher, but most of the inflation components are coming from the service sectors. And we are not going to see anytime soon inflation coming from this sector.
Right. Okay. So then I have to make the inference that you're not very bullish on gold in the intermediate term then, if you expect real interest rates to stay where they are.
On the contrary, actually what I think is that the consolidation in the price of gold that we saw since the month of August, right? Since the month of August, a gold price has gone down by about 13%. This was the direct consequence of the readjustment in nominal rates and on a US dollar that hasn't been doing anything over the last 3 months. And remember, we talked about those two stress tests that we had in November and in January. And this also has definitely affected the performance of the price of gold. Mm-hmm. What we believe is that since nominal rates have hit that tipping point, this is the green light for gold to go higher, whether we have more inflation or not. Because the inflation expectations that you see today at north of 2% are going to stay here. They are not going to go down anytime soon. But it doesn't mean that we are heading towards much more inflation. So forget for now the hyperinflation, the commodity super cycle. Forget it in a second. And let's focus just on the fact that nominal rates are not going to go higher. And that in itself is the green light for gold to go higher.
Okay. I have to ask you then, if nominal rates will not go higher, couldn't gold just stay flat? Why does gold necessarily? Because what you're saying basically is there's going to be a divergence between gold and real interest rates now going forward, right?
What I'm saying is that the danger of having higher real rates has elapsed.
Okay.
What the market was worried about was nominal rates to continue going higher while inflation was climbing, but not at the same pace as nominal rates.
Yes. Okay. So as
suddenly that fear of higher real rates is going to fade. And this is exactly what we need to see for gold to outperform.
All right. So as we speak today on Monday, gold is at around 1809 US an ounce. Is this the bottom for you then? Could it go a lot higher from here, or just a few $100s? What is your expected range of movement?
Well, gold is up today, David. Gold is up, and the equity markets are down, and real rates and nominal rates are, the 10-year is around 135. So this is what we think. What we think is that this consolidation phase that has lasted almost 8 months is almost over, and gold is fluctuating in the 1800 level. It's close to its 200-day moving average. It's playing with those averages. It's playing with those supports, and we might have a few more weeks. I don't think a few more months. We may have a few more weeks where the market will have to decide whether nominal rates are going higher or not, whether inflation expectations are going to stabilize at these levels. And once this when this dust settles, we will have again a nice performance of the price of gold. Mm-hmm. And I think that's what we have seen over the last two sessions. And this is again an epiphenomenon, and we need to validate it. But it's very reassuring to see that gold is resisting at those levels when nominal rates don't seem to want to go higher.
I understand. All right, Alain, fantastic update as usual. Thank you very much for your time today.
Thank you very much, David.
And thank you for watching Kitco News. I'm David Lin.